The title of the talk is Indecision, and I don't like to sound like I'm indecisive, but the truth of the matter is I am. We have a very odd market out there, and I don't mean the resource market. I mean the big markets worldwide. Intermarket relationships are very unusual right now. It's almost like we've got this state of equilibrium, but it's not static equilibrium. There's a lot of the markets, and I mean the big markets like the credit markets, the currency markets, even though we have what looks like static equilibrium, I don't really think it is. It is one of those situations, a classic situation where, say, a policy mistake can blow things up. I'm not saying that's going to happen, but I'm saying this is not, in terms of the big markets, it's not a low-risk market. We're all going to definitely have to stay on our toes for the next few months. And really, right now, I would say the chart that's up there right now is probably the most important one in the world. That is the chart that just shows the cumulative total of negative nominal interest rate bonds. They're essentially all sovereign bonds, ones issued by countries. We went through 17 trillion a few days ago. Honestly, it's insane. I mean, it's nuts. I don't know. There's no other word for it. You really have to wonder what set of conditions drives the market to these extremes, and that's really the question any sensible person has looking at that is, how did we get here? Why would somebody even be in the buy side of the market when you see a market that's like this? And really, the thing to remember is bond markets. The bond market's a bigger market than the equity markets. It's a different market. People tend to focus on yield. Equity traders, most retail traders, when they look at bonds, they're looking at yields. They focus on the yields. Bond traders don't focus on yield, they focus on price. And the chart you see in front of you right now, that's an ETF, it's called TLT. And what it is 20-year plus US bonds, not the yield, the price. In other words, if you were to go today to buy $100,000 of a 20-year bond, what's it going to cost me in terms of face value? And one thing you'll note if you look at that is the bond market's had a pretty bloody good year. It's had a better year than the equity market has, significantly better actually than the big equity markets. That's why people are in the market. That's why the bond traders are still in this stuff. They're buying because they're buying. They're long because they're long. The question is, it's definitely a bull market, but the question is, where does this end? Because we've gotten to extremes already. And I wanted to give you a longer-term look at this just to give you a sense of why the bond market, aside from the obvious reasons that pension funds, insurance companies, et cetera, have to own bonds. Those are all regulated sectors that can't really own that much equity. They need to own bonds, and they need to own sovereign bonds generally in particular. But these two charts here side by side, the one on the left is TLT, the same one I just showed you. But it's a weekly chart that goes back to the inception of that ETF, which was about 2002. The one on the right is the S&P over the same period. I won't make you do the math, but basically, if you look at TLT from its inception, and keep in mind, this is not coupon. This is an ETF that tracks the price of bonds. If you actually owned all those bonds, you'd be getting interest payments as well. It's up about 225% since 2002. S&P's up 150 maybe. Essentially, the bond market has beaten the equity market for a very long time, actually. It is, in fact, the longest running bull market, I think, in history. It's been going since 1981. A lot of people, including me, thought it was done when Trump got elected. It looked like it would be. It's come back again. I have to think at this point we are getting close to the point where it's done, because it really is, reaching the absurd with the amount of these things that are at negative levels. So if you're a bond buyer, or if you're someone who's got FOMO and you're going into that market and you're looking at negative yields, why would anyone be buying in a market where most of the yields are negative? Obviously, and this is the thing to remember, this is why when people look at negative yields, they go, it doesn't make any sense. But remember, most bond traders don't really care about yield, they care about price. So purely and simply, it's in a bull market, they're buying because they think the price will go higher. If that happens, yield goes lower. But this is all about buying the price. Not to put too fine a point on it, there's a lot of FOMO here. And there's still, especially lately, a lot of buying that's, if nothing else, it's greater fool theory, really. Same thing that drives any bubble at its peak. people are buying on the assumption they're going to be able to turn around and sell it at a higher price to somebody else. The other thing, though, is it's pretty clear that there are a lot of traders in the bond market that are expecting not only flat inflation, but in fact deflation. That's the only way you can make any sense. Out of anyone who would buy a bond with a negative yield and hold it for any length of time, you must be expecting inflation to probably to turn into deflation. I'm hoping that they're wrong about that, because as much as we all like to hate central bankers, you don't want to be a central banker in a deflationary period, because it is the toughest thing to deal with if you're a central banker. It's very, very hard to get out of that corner, which is why a lot of central bankers are trying so hard to keep it from happening. That's why you're seeing, talk about renewed QE and things like that, because once you get into that paradigm, it's extremely difficult to get out of as a central bank. Nobody wants to be going there, including me. So I hope it doesn't happen. I'm not really convinced that it is, but the truth is, I do think we have to keep in mind here, this background has been very favorable for us the last little while. This is what's driving the gold price higher as much as anything. But we do have to keep in mind that I don't see how you look at a market where you've got 17 trillion in negative yields and call it anything but a bubble. And as we all know, bubbles burst. So, I'm not saying we aren't going to have a great bull market in gold. I think we are. We're in it already. But, we got to stay on our toes, because things like this can come at us out of left field. And when the bond market goes bad, it takes everything with it, believe me. It is the mothership. So we can't ignore that stuff and just go, yay, gold's up today. Who cares what's going on anywhere else? You have to keep an eye on this stuff. Side effects, one of them has been, obviously, it has been supporting equities, particularly Wall Street. I mean, there is a very strong and obvious inverse relationship between bond yields and share prices. Bond yields drop, share prices go up. I mean, stocks do, in fact, have their own dividend yield. So there's a pretty well-known and well-followed negative relationship. But one thing I think is interesting is, everybody talks about how hot Wall Street is. But when you look at this chart, and this is just a 3-year S&P chart, truth of the matter is, the market's basically done nothing for the last year and a half. S&P's been going sideways. And that's part of the reason why I've been a little bit paranoid, a little bit hesitant when it comes to the big markets, because when I see bond yields doing what they're doing and I see the S&P going nowhere, that's telling me there's people that aren't drinking the Kool-Aid on Wall Street. There's obviously people out there that aren't worried. They're not chasing the price higher, which is what you'd expect. It's basically been flat for a year and a half, and the news out of the U.S. hasn't been terrible. So there's obviously stuff out there that's worrying people. They're not driving it higher, but they aren't driving it lower yet either. The other thing that obviously, and this is what we all care about, especially the guy sitting at the table there, here's a gold chart for the last year. Beautiful chart, obviously. We're all fairly happy campers. It's up over 1,500. Everybody got freaked out yesterday. And there's going to be days like yesterday. The gold price got pretty extended. If you look at the top, I don't know if this pointer works. If you look at this up here, you can see you were getting up into pretty overbought territory. It was kind of time for the gold price to kind of settle down a little bit. I think it's likely we're going to see a bit of sideways. And whether we see sideways or a bit more down, largely is going to depend on what the Fed does this month. I think the Fed is going to cut 25 basis points. There still seem to be a lot of people on Wall Street and a lot of people in the bond market expecting 50 basis points, which, frankly, unless something blows up, I think the odds of that are pretty close to zero. I just don't see it happening. I don't see why they would do it unless something else is blowing up. So I'm assuming 25 basis points, and I'm not sure what they do after that, because I don't know if any of you are in a habit of checking FOMC speeches, but there's several members on the FOMC, which is the Federal Reserve Open Market Committee. That's who makes these interest rate decisions. There's several members that sound like they're not very happy about the idea of even cutting this month. I think they're going to do it because I think they all like Powell enough, and it's pretty obvious Trump will fire him if he doesn't do it. I don't think that's legal, but that hasn't stopped Donnie before, so why would this time be any different? So I'm assuming that kind of least we're going to get. One thing down here that it's also interesting to take a look at, and I've talked with this a couple times in the newsletter recently, this bottom graph that you see, that's basically the correlation between gold and the US dollar. It's like a truism in the gold market that I've never agreed with, by the way. that gold and the dollar always trade against each other. Dollar goes up, gold goes down, vice versa. Dollar goes down, gold goes up. That's not really true. The correlation shifts back and forth all the time, as you can see from this. But it's particularly interesting how strong the correlation's been. It tells you how strong a gold market this is, that we're getting positive correlation with the dollar and a rising gold price, which basically means gold's going up faster than the dollar. And it's not like the US dollar hasn't been doing well. It's been doing okay too. I mean, my biggest concern, honestly, in the short term, if there was something that I thought was going to blow things up, would be the US dollar really taking off. I mean, it's not hard to make an argument. I know gold bugs will all tell you it's going to zero, like blah, blah, blah. But if you look at actual fund flows, currency movements, credit markets, it's not actually hard to make an argument for the US dollar to really take off. And that would be a bad, bad thing for a lot of markets. And everybody knows it. I mean, I think that the bond market guys have one big worry. It's the US dollar taking off, because it screws up a lot of things, including the US. If it happened, it would probably be short term, because it would probably push the US into a recession. But that's the only thing I've really been worried about the last couple of months. And that's why I'm happy to see this positive correlation. And to give you some idea, I just wanted to show you this. This is a long-term chart going back to 71. It's not a current chart. The chart ends about 2013. But I just wanted to use this to reinforce it. And what you're looking at here is, this is the gold price, obviously. This is positive or negative real interest rates. You can see, you look at this period here during the 70s where the Fed was behind the curve, which just means they weren't raising rates as fast as inflation was going up. That, of course, is the last great bull market, if you will. This period from 81 all the way through to 2001, where it was basically positive and usually strongly positive interest rates the whole time, real interest rates, that is, after inflation, pretty much sucked for the gold market the whole way through. This is where things picked up again. And obviously this year, after going into the QE after 2009, that's where you really saw a takeoff. This lifted back up over the next couple of years, but if you pull this right to today, you'd see it diving, like really diving in the last 6 months. And that's why we've got such a strong tailwind under the gold price right now. And I don't see that changing anytime soon. I'm not convinced that we're going to see inflation drop enough in the US to pull their real interest rates back into positive territory. I don't think there's a hope in hell of it happening in Europe anytime soon, probably not in Asia either. So globally, I think the negative real rate environment's here for a while, and that's the best time to own gold. It's also the best time to own, it's the best time to own commodities in general, but the fact that it's not helping base metals, it's not helping oil, that's another reason why I'm, a little bit squeamish about the economy. In a normal growing economy where most of the world's big trading blocks were doing okay, this kind of negative environment wouldn't just be good for the gold price. You'd see copper doing great, zinc, oil, all of them. Gold and silver are pretty much the only ones getting any love out of this, which tells you there's issues on the demand side for base metals and for oil, which is not a good thing, obviously. And just to kind of close off, and I know I'm not talking about gold much, but I'm focusing on this because this is so important to the gold market. This is a long-term chart, and it goes into the same thing. This chart's generated by the New York Federal Reserve, one of several regional Federal Reserve banks. Basically, what they use is the yield curve to generate a recession probability 12 months forward, and it's essentially the 10-year minus a 2-year, essentially. It's a very good indicator. It stinks for timing. It could be 3 months out, it could be 18 months out, but in terms of is there or is there not going to be a recession in the next few quarters, it's got a very strong track record. And as you can see, when you get up to the level it's at now, it's at 37%. There's really, you take this all the way back, there's really only one false positive in 1997. The other ones, this is a pretty reliable indicator, and that's why I've harped on this. I mean, my readers have seen it in my newsletter several times in the last few months. It's because it is a very reliable recession indicator. And I don't, there's only one case I know of where it got up to 37% where it is right now, or 37 basis points actually, where it is right now, where you didn't see a recession within a few months. And in fact, most of the time when it was this high, the recession was right on top of them. And people just didn't realize it until the basically rearward looking stats showed up 6 months later. Everybody going, oh, the recession started in August. And that may be where we are now. I don't think so, but I think we're probably close, unfortunately. And one other thing I just want to point out, this is US stuff I'm using here, obviously. I'm not a big fan of consumer sentiment surveys. I generally don't pay a lot of attention to them. Month to month, I pretty much pay no attention to them. I've never found them a great leading indicator, but in a big picture sense, when you're looking at a long-term trace of these numbers, they are useful when you see the kind of rollover that we're seeing right now. Here's the last 3 recessions, and you can see these rollovers that you get just as you're going into it. You're getting one of those right now, notwithstanding all of the major media telling you how positive everybody is. That's a fairly large drop in the last 2 or 3 months. Maybe it bounces up again, but there's no, we all know why the drop's there. It's the trade war. I mean, really the trade war is probably the main reason, but because of all the trade problems, because the corporate side has been skittish for a while now. Corporate investment in the U.S. and Europe and Asia has been low for a couple of years. It's really been the consumer carrying the weight for the last couple of years. They are the driver of the economy. So seeing this again makes me a little bit nervous that I think we're probably a lot closer to a recession than anybody wants to believe, including me. Which isn't bad for the gold market, mind you, but it may not be as good for Wall Street. So, I mean, it's just a very strange market. A lot of the intermarket relationships that you normally see, they're just not, things aren't trading the way they normally do against each other. It's a very weird market. I'm sure a lot of this is due to, 10 years of QE, forced low interest rates. I don't really think anybody knows what the end game looks like here. I'm not going to stand here and tell you, here's the 5 things that are going to happen in the next 2 years. I don't think anybody knows because we've never had markets trading this way against each other. I suspect we're going to get surprises. I hope they're pleasant ones. I mean, there's plenty of roots out of this that aren't that nasty, but it is one of those markets where we're really going to have to stay on our toes because this is the type of market where things come out of left field, and it's usually a black swan that blows everything up. And I just don't know what it would be if it happens. So I'm staying focused on gold and silver. I mean, I'm fine with silver. I'm not a silver bug, so I don't go out of my way looking for silver deals, but I'm fine with a good one. But I'm pretty much sticking with gold deals. That should be obvious from who's sitting in the panel here. Developers will do great. I think we will see some M&A, but there will be a lag. I've had a lot of subscribers ask me, how come this company or that company or the other company you're following isn't getting taken over? I've got a few on my list that I think will. But normally the way this works, when the market turns and we go into a gold market, most companies that do M&A activity, their currency isn't currency. Their currency isn't dollars, it's their stock. So normally the boards of those companies, they want to see their own share price move, preferably significantly, and the farther it moves, the cheaper a takeover feels to them. A company might be looking at company A today, and they'd have to issue 20 million shares to take them over. If gold keeps going up, both of those probably go up, but odds are that company can do the same takeover in 12 months or 9 months for 15 million shares or 12 million shares, and to them it feels cheap. So you do tend to see the most M&A activity once you're into one of these, not at the start of the cycle. It should be at the start. That would be the smart thing for them to do, but they never do the smart thing. They always buy at the top, which is good because they always overpay, which is also good because we're the ones getting bought, not the ones getting sold, so I'm okay with that. Overpaying is good. Base metals, I've got a lot of base metal stories on my list still that I love. They're great deals, great management, great projects. I'm not going to be selling them, but it's going to be hard for base metals. I mean, make no mistake, very difficult sentiment-wise. I mean, I've got 2 or 3 great zinc deals on my list, and it's hard. It is, I talk to management, and they're like, what can we do? And it's like, nothing. I honestly don't think you can do anything. You could put out any type of news and the market isn't going to care. Unfortunately, that's just how it is sometimes. You're in one of those periods. And until we see I think the economy, unequivocally either go into a recession, come out the other end of it, or unequivocally move enough that it's not going to go into one. The one thing that will obviously be the biggest help, and it could also keep the economy going into a recession, of course, is a trade war ending. I think it's going to in the next few months. I think Trump wants out of it before the next election because it's definitely not helping his poll numbers or his election chances. I've said from the start that I think China is in a stronger negotiating position, not because they're in a better economic position, but because they're willing to take more pain. and I still believe that. So I don't think he's going to get the long end of the stick, but I do think he's probably going to make a deal in the next few months because his party's going to be screaming at him to do it. So that may be what gets us out of all this, and that will create volatility. Anything like that is going to create a lot of volatility going forward. We have to be ready for that, but I certainly wouldn't be freaking out about the fact that gold went from 1540 to 1500. I mean, we haven't gone into a downtrend. It was a one-day drop. Everybody calm down. It's fine. Like, be on your toes, be willing to take profits, but gold developers, gold explorers, I think that's the place to be. That's where I am. That's where I'm putting my money. That's where I think we're going to have some fun. And there's a lot of money coming into this sector. I think we've only seen the leading edge of that. I mean, I'm talking to more and more generalists that are aiming money at gold because it's not just negative interest rates. It's people are worried about this very weird economy, this very weird situation the markets are in. And there's more and more generalists saying, I think I want to have 5 or 10% of that, just in case. I don't love the gold market, but I understand it as an not so much inflation hedge as insurance. And the truth of the matter is, the gold market isn't tiny anymore, but it's still pretty small compared to the other sectors that money's coming out of. So, I mean, the potential money flow is actually quite large. It can move things a long way. It's been actually 20 years, I would say, since we've seen that kind of market. I'm not convinced we're there yet, but if I can remember that market the last time around, and it was a lot of fun if you were in early, like most of you sitting in the audience are. So let's cross our fingers and hope that's what we get. And that's about it. I mean, favorable gold market, but just keep in mind the low volatility days that we had for 3 or 4 years on the major markets, those are done. I don't think those are coming back anytime soon. Whichever way things go, it's going to be big, hard lurches. So just be prepared for that. And with that said, I mean, I'll be around. We'll obviously be next door after this for questions. If I'm around all day today and tomorrow, anybody wants to ask me about anything more specific, I want to move on to the fun part, which is the guys that all promised are going to make us all money. They swore on a Bible before they came in here. I made them do that. And the first one who's going to make us rich